It has been a very difficult year to make much money. Hard in stocks, hard in bonds, difficult in commodities. What is the market telling us about the future of the global economy, not just the U.S. economy?
I think a lot of what the market is doing actually makes a lot of sense if you think about where we are in the business cycle. We're now entering the 10th year of this expansion. By next summer, it'll be a record if we're still in growth territory at the time. The unemployment rate, the lowest in almost half a century, and the Fed is worried about inflation, so it's tightening. In those circumstances, it gets tougher for risk assets. Now remember, any risk asset, whether it has benefited from the fact that the return on cash has been zero for most of the last 10 years. Turkish bonds, Bitcoin, General Electric common stock, they all seemed like worth owning when your alternative was zero. The fact that you can now get 2 to 3% essentially risk-free means it's harder to justify those risk assets. So let's not be shocked that the markets, both the corporate bond markets and the stock markets, are struggling now. The more interesting question is, are they telling us that the economy itself is getting in trouble? We don't see a lot of data at that point, but I think you logically have to say that the odds of a recession have gone up.
But you do see it in some foreign economies.
Yes, that's kind of interesting. The U.S. economy has essentially been surfing this fiscal stimulus for the last year, while almost every other economy overseas struggles. We've got Germany and Japan both with negative third quarters. China slowing to its slowest growth rate in a decade. Again, that doesn't necessarily mean the U.S. has to follow suit, but it's likely that those paths are going to converge. The U.S. has grown 3% over the last year. It's almost impossible to imagine the circumstances lining up in such a way to give us that same pace of growth again. So there's going to be a slowdown. Nobody would be surprised. The Fed at this point is not surprised that things are slowing. The question on everybody's mind is, does it overshoot, and that a collection of risk aversion, trouble in the markets, Fed mistake, give us an actual recession?
The headline, Greg, was really interesting, markets sounding the alarm, because the thing that I thought of immediately was, even if the markets are sounding alarm, the Fed's not listening to that alarm. I mean, they made it pretty clear that it's going to take a lot more in terms of market volatility in order for the markets to be any sort of input at any future meeting. So it actually, for all of what investors' angst is here in these days with, Apple, for instance, down 25% from its highs, et cetera, and the list can go on and on and on in terms of stocks off their highs, it doesn't make a difference to the Fed.
Right. I don't see the Fed getting worried about it at this point. I mean, we've been spoiled, right? I mean, we're only at 10% down on the S&P 500. That's barely a correction. The sell-off in credit has barely raised the spread, the investment grade or the speculative grade bond spread. These are not horrific conditions, certainly not as bad as just as recently as, say, 2015. And the Fed has also been puzzled and a little bit worried that since they started tightening, they began raising short rates in 2015, began shrinking the balance sheet last year, is that overall these risk assets have gotten frothier. So there might be some people a little bit pleased or relieved that some of the froth has come out. The question always is degree. They don't want to overdo it. And the Fed, they're not the leader of an orchestra here, where the orchestra responds exactly how they want it to. They're more like the leader of a mob, and mobs can't be controlled. They can only be incited. So there's no telling where this ends. Right now, I don't think it's worrisome for the Fed, but watch this space.
Yeah, and also one of the things that stands out to me, I mean, Powell will have a press conference in December, and then every other meeting going forward, he's going to have a press conference. So there's going to be a lot more opportunity for him to communicate, and also for the markets to interpret what he says, but may not necessarily mean. So I think next year could be a very interesting year of Fed watching. Greg,
Tyler, that's a great point, and I actually want to expand on it a little bit, because one of the ways the Fed has kind of helped the economy is being very transparent with their plans, giving us lots of forward guidance about where rates are going. Chairman Powell has made it clear that those days are over, both because it's not necessary any longer, and it's really not his style. So he's actually been trying to get us to pay less attention to the dot plot. And I think he is the type of chairman who's much more likely to sort of like play it as it goes. I remember his first press conference, he told us, we made one decision today and one decision only. So I think one of the things that markets are going to have to get used to is less guidance, less hand-holding from the Fed. That may not be a bad thing in the long run, but in the short run, I think it's giving us volatility.